Close your eyes. I am asking you to do something that financial television never asks you to do, because financial television is afraid of silence, afraid of the kind of quiet in which a person actually thinks. So close your eyes for just 10 seconds and imagine something with me. Imagine that you wake up tomorrow morning and 20 million barrels of oil have not been reduced, not been curtailed, not been placed under diplomatic review or subjected to a working group or studied by a committee. They have simply vanished. The tankers have stopped moving. The refineries are starving. The pipelines are hollow. And every nation on this earth, every single one without exception, wakes up to the same cold and irreversible question. Where does the energy come from now? You can open your eyes, because what I just described to you is not a thought experiment. It is not a scenario from a geopolitical thriller. It is the physical reality of March 2026. The Strait of Hormuz, that 21-mile wide choke point through which roughly 1/5 of all the oil on this planet flows every single day, has been functionally closed. And tonight, on this Sunday evening, while the cable networks recycle their talking points and the financial press congratulates itself for covering the oil price, I am going to do the one calculation that nobody in mainstream finance has had the courage or the curiosity to perform. I'm going to translate those 20 million missing barrels into kilowatt hours. I am going to translate those kilowatt hours into gigawatts of replacement power. And I'm going to translate those gigawatts into ounces of the only metal on Earth that can fill that void. And when I am finished, you will understand why silver, sitting tonight at approximately 69 to 80 per ounce, is not merely undervalued. It is a price that can only exist in a world where the arithmetic has not been done. We are doing the arithmetic tonight, right here, on the OG John Ag. Every number, every conversion, every implication. But before we begin the math, I want to say something about why this matters beyond the trade, beyond the portfolio, beyond the price target. What happened in the Strait of Hormuz is a civilizational stress test. It is the moment where the abstract promises of energy policy collide with the concrete and unforgiving physics of the real world. Physics does not negotiate. Physics does not hold press conferences. Physics does not issue guidance. Physics simply presents you with the consequences of your choices, and right now, the consequences are arriving at 20 million barrels per day. Let us begin with a number that sounds almost too large to be real. 1 barrel of crude oil contains approximately 1,700 kilowatt hours of thermal energy. That is not an estimate. That is a measurement. It is the energy content of 42 gallons of crude oil expressed in the universal language of power. To give that number a human dimension, consider that the average American household consumes roughly 30 kilowatt hours of electricity on a typical day, which means that a single barrel of crude oil, in raw energy terms, contains enough thermal power to run that household for approximately 56 days. 56 days from 1 barrel. That is the energy density of oil. That is why civilization was reorganized around it. That is why the strait through which it flows is worth fighting wars over. And that is why 20 million missing barrels is not a price event. It is a physics event. 20 million barrels per day, multiplied by 1,700 kilowatt hours per barrel, produces a number that I want you to hold in your mind with the seriousness it deserves. 34 billion kilowatt hours per day. That is the energy that disappeared from the global market when the strait closed. Not the economic value of that energy, not the paper price of the futures contracts written against it, but the actual physical energy, the electrons and heat and mechanical force that the global economy needs to function, that has simply ceased to flow. And that hole does not heal. It does not improve gradually. It does not respond to statements of concern from foreign ministries. It sits there, 34 billion kilowatt hours wide, every single day demanding to be filled. Now we convert. A 1 gigawatt power plant running at full capacity around the clock for an entire month produces approximately 720 million kilowatt hours. Take our 34 billion kilowatt hour daily deficit and convert it into the continuous generating capacity required to replace it, and you arrive at approximately 1,416 gigawatts of instantaneous power. But here is where the calculation becomes specifically relevant to the near-term response that markets will be forced to price. The world does not need to replace all of that oil energy with electricity immediately. What it needs to replace, what governments are already in emergency discussions about replacing, is the portion of that oil that powers electrical generation, industrial processes, and transportation networks in the importing nations most acutely affected. And when you scope it to the realistic emergency deployment scenario, which is the accelerated solar build-out that multiple governments were already planning before the strait closed, you arrive at a figure of approximately 19 gigawatts of priority new generating capacity that needs to be deployed in the near term. 19 gigawatts. Remember that number. It is about to become the most important number in the silver market. And if this is the kind of analysis you have been looking for, the kind that connects the dots that the mainstream financial press refuses to connect, then subscribe to this channel right now. Hit that button, Because what comes next, the part where the energy math turns into a silver story that Wall Street has not modeled, that is what the OG John Ag exists to bring you. Subscribe before I continue, because you do not want the rest of this interrupted by the thought that you might miss the next video. Where do 19 gigawatts come from? That is the question that determines everything else. They do not come from nuclear. Nuclear power plants require between 10 and 15 years of permitting, construction, and commissioning. They do not come from coal. The Western world has spent the better part of a decade systematically closing its coal capacity under pressure from climate policy, and the remaining plants are operating at reduced margins with diminishing pools of trained operators. They do not come from natural gas, because the same geopolitical disruption that severed Hormuz oil flows has also rattled liquefied natural gas shipments to Asia, pushing gas prices sharply higher at exactly the moment when demand is surging. What remains? Solar. Solar is what remains. Solar is the only energy source that can be manufactured at gigawatt scale and deployed within months rather than decades. Solar panels do not require a decade of environmental review. They do not require the construction of a containment structure. They do not require a pipeline or a port. They require land, labor, inverters, wiring, and one other thing. They require silver, not copper as the primary conductive element, not aluminum, not some laboratory-engineered substitute that a materials scientist has been promising for 15 years. Silver. Physical silver, element 47 on the periodic table, the most electrically conductive element in the known universe. The element whose conductivity is not a human preference or an engineering decision, but a consequence of atomic structure, established 4.5 billion years ago, utterly indifferent to the opinions of commodity analysts or the positioning of futures traders. Each gigawatt of solar generating capacity requires approximately 700,000 ounces of silver. That figure comes from solar panel manufacturing data and has remained roughly consistent through the current generation of photovoltaic cell design, 700,000 ounces per gigawatt. Multiply that by our 19 gigawatts of required replacement capacity, and you arrive at 13.3 million ounces of silver, 13.3 million ounces of implied new demand, created not by investor enthusiasm, not by a bullish report from a precious metals consultancy, but by the elementary physics of replacing 20 million barrels of missing oil with the only energy source that can be deployed fast enough to matter. And I want to be precise here, because precision is the discipline that separates analysis from advocacy. This is not a perpetual demand figure. Solar panels, once installed, produce electricity for 25 to 30 years without requiring additional silver. So the 13.3 million ounces represents the ramp-up demand, the silver consumed during the construction phase of the 19 gigawatts. Once those panels are installed, the ongoing demand for maintenance and replacement is far smaller. But those 19 gigawatts do not yet exist. They are not built. They are not funded. They are not yet ordered. They need to be manufactured, panel by panel, cell by cell, and every cell requires silver. The ramp is not behind us, it is ahead of us, and the silver needed to climb it is being held right now in a vault system that is under a level of stress that the price has not yet begun to reflect. Let us talk about that vault system, because this is where the abstract becomes urgent, and the urgent becomes something very close to alarming. The COMEX registered silver inventory, meaning the silver that is formally warranted and available for delivery against futures contracts, stood at approximately 124 million ounces as of the most recent exchange data. Registered stocks had already fallen sharply from over 500 million ounces in combined eligible and registered inventory just months ago, with registered alone having dropped nearly 32% in the span of 4 months, touching lows around 88 million ounces in late February before recovering slightly. The paper claims outstanding against that registered inventory. The open interest in silver futures contracts represent approximately 7.5 paper ounces for every physical ounce available for delivery, 7.5 to 1. That ratio is not a warning. That ratio is a detonator, and the geopolitical events of March 2026 are the match. Consider what 13.3 million ounces of new solar demand means against a registered inventory of 124 million ounces. It represents more than 10% of the entire deliverable supply consumed by a single application of a single emergency energy scenario. And that is before accounting for the existing industrial demand that was already absorbing silver faster than mines could produce it. The Silver Institute had already documented 6 consecutive years of market deficits, a cumulative shortfall of more than 800 million ounces between what the world mines and what the world consumes. 6 years of deficit, 800 million ounces of structural undersupply before a single emergency solar panel was ordered in response to the Strait of Hormuz crisis. Add to that the Chinese demand picture, which deserves its own moment of serious attention. Publicly available import data indicated that China brought in 790 tons of physical silver in just January and February of this year. Not paper contracts, not ETF shares, physical metal, crossing a border, entering a vault. 790 tons in 60 days. That is approximately 25.4 million ounces, drawn from the same global supply pool that is already running a structural deficit. And the question that the market has not answered, the question that the price of $69.80 implicitly assumes has a comfortable answer, is where exactly all of this demand is supposed to be satisfied. The mining industry produces approximately 26,000 metric tons of silver per year, a figure that has been roughly static for several years despite rising prices, because silver is predominantly a byproduct of mining for other metals, particularly copper, lead, and zinc, and those primary metal markets have their own supply constraints. You cannot simply order more silver mines. You cannot turn on additional production with a policy announcement. You build a mine over the course of a decade, navigate the permitting, construct the infrastructure, hire the workforce, and then produce what the ore body gives you. The inelasticity of silver supply is not a talking point. It is a geological reality. And the demand side of this equation is not static. It is accelerating. Here is the part of the story that has received almost no attention in financial media. And it is the part that I find most historically significant, because it speaks not just to the silver trade, but to the deeper structural failure of Western energy policy. The Western world did not simply lose access to Hormuz oil. It arrived at this moment having already systematically dismantled the industrial infrastructure that would allow it to process and substitute for that oil. Over the past 10 years, refineries in the United States, Australia, and Europe have been closed, denied permits for expansion, and subjected to a regulatory environment so hostile that no rational capital allocator would invest in new downstream processing capacity. These were not decisions made in ignorance. They were decisions made with ideological confidence, the confidence that the energy transition was proceeding on a schedule that made new refining investment unnecessary. The confidence was misplaced. The transition is not proceeding on schedule. The fossil fuel infrastructure is being dismantled faster than the renewable infrastructure is being built. And the gap between those two curves is exactly where this crisis lives. Refineries do not merely produce gasoline. They produce diesel for trucks and trains and ships. They produce jet fuel for aircraft. They produce heating oil for homes in climates where winter is not a rhetorical device. They produce petrochemical feedstocks for fertilizers and plastics and pharmaceuticals and materials whose supply chains most people never think about until the supply chains break. And right now, simultaneously, the crude oil supply is severed at the Strait of Hormuz, and the refining capacity to process whatever oil does remain accessible has been hollowed out by a decade of policy choices made in a more optimistic moment. It is a double choke point. The supply is cut at the Strait, and the processing capacity is cut at the refinery. And you need both to make fuel, and the Western world is short of both at the same time, and the people who made the decisions that produced this vulnerability are, with admirable consistency, declining to acknowledge the connection. This brings us to the profound and slightly bitter irony at the center of this story. The same green energy ideology that contributed to the destruction of refining capacity and the blocking of new fossil fuel investment is now the only available response to the crisis that ideology helped create. Solar and wind are not merely the preferred option at this moment, they are the only option that can be deployed at any meaningful scale within any time frame that matters to the governments currently holding emergency energy cabinet meetings, which means that the energy transition, which was proceeding at the pace that policy preferred, is now being accelerated by the force of necessity. And that acceleration, every gigawatt of it, every solar panel manufactured and installed in the desperate sprint to replace the missing oil, runs through the silver market. The green transition was already consuming roughly 20% of global annual silver supply for solar manufacturing alone before the Strait closed. Now that figure is going to rise not because of a subsidy program or a climate summit resolution, but because governments have no other viable path and they know it. This is silver demand created not by optimism, but by desperation. And desperation does not negotiate price. Desperation pays whatever is asked. Now let me walk you through the technical picture because the charts are telling a story that is perfectly consistent with the fundamental analysis I have just outlined, and the levels are specific enough to be useful. Silver closed last week at approximately $69.80 per ounce after a volatile session that saw it recover from midweek lows near $67.75. That recovery on a Friday, with maximum geopolitical risk overhanging the weekend, is not a meaningless data point. Institutional buyers do not commit capital on Friday afternoon before a weekend of potential Hormuz escalation unless they have conviction that outweighs the uncertainty. Looking at the daily chart, the 100-day simple moving average sits in the vicinity of $73 to $74. That level is acting as the key overhead resistance. Below current prices, Critical support rests at the March 26th low of $67.75, and below that, the weekly low approaches the 65 range. So the range is defined: support in the $67 to $68 zone, resistance approaching $73 to $74, and silver is currently trading in the middle of that band at $69.80. The relative strength index has been trending upward from deeply oversold territory. It has not yet crossed into bullish momentum, but the trajectory is clear. The sellers are losing energy, the buyers are accumulating, and the RSI is coiling toward a level that, when breached, historically precedes significant directional moves. For the bulls to decisively reclaim the trend, silver needs a clean close above $70. Above that, the path runs to the 100-day moving average near 73 hours, then to prior resistance around $77 to $78, and above that to the 20-day moving average, which has been serving as a ceiling through the correction. But I want to say something about technical analysis that the practitioners of technical analysis sometimes prefer not to acknowledge. Charts record history. They are a map of where the price has been, drawn with the assumption that human behavior, being somewhat predictable, will repeat familiar patterns. That assumption holds beautifully in normal markets, in markets where the fundamental supply and demand picture is stable enough that price movements are primarily expressions of sentiment and positioning. It does not hold in markets where the fundamental reality has changed so dramatically that the old patterns become irrelevant. When a genuine supply shock arrives, when the underlying physical scarcity becomes acute enough that buyers must compete for metal that is simply not available at any recent price, technical resistance levels do not slow the price. They get gapped through. The traders who are short at $70 based on the 100-day moving average and the RSI find themselves providing the fuel for the rally as their stop losses trigger a cascade of forced buying. The technical analysis is useful right up until the moment the fundamental catalyst overwhelms it, and I believe the convergence of the Hormuz oil disruption, the structural solar demand shock, the 6 consecutive years of supply deficit, the Chinese physical accumulation, and the extraordinary paper-to-physical leverage ratio in the COMEX system represents exactly that kind of catalyst. The chart resistance at $73 and $70 will not be meaningful speed bumps when this moves. They will be floors after the gap. Let me offer you 3 scenarios for how the next 30, 60, and 90 days might develop, because serious analysis requires an honest accounting of the range of outcomes rather than a single confident prediction delivered with theatrical certainty. In the first scenario, the Strait of Hormuz reopens within weeks. Oil flows resume, the acute crisis passes, the geopolitical temperature drops. Even in this scenario, the lesson has been permanently absorbed by every energy minister and national security council on Earth. No government wants to experience this vulnerability again. The emergency solar deployment programs that were announced in crisis are not canceled in relief. They are accelerated in determination because the political will to reduce dependence on Hormuz transited oil is now bipartisan, transatlantic, and essentially irreversible. In this scenario, silver goes higher. It goes higher gradually rather than explosively, but the structural demand increase from solar manufacturing is permanent, and the price reflects it over the following quarters. In the second scenario, the strait remains closed for months. Oil holds above the $100 threshold. The global economy enters a demand destruction recession, the kind driven not by financial excess, but by the raw physical unavailability of affordable energy. Governments launch emergency solar deployment programs with the urgency language previously reserved for military mobilization. Silver demand from industrial solar manufacturing surges. Simultaneously, investment demand for silver increases because it occupies an unusual position in this environment as both the industrial input for the only viable energy transition and the safe haven asset for investors in an economy under structural stress. In this scenario, silver does not merely trend higher, it gaps higher. It moves from $70 to $85 to $100 in the kind of compressed time frame that leaves most investors either very wealthy or very regretful, depending on when they paid attention. In the third scenario, the crisis escalates. Military conflict extends beyond the strait. Multiple energy infrastructure targets are threatened or struck. Oil pushes above $130, $150. The global economy enters a severe recession of the kind that restructures political systems and rewrites the rules of international trade. Governments declare formal energy emergencies. Solar manufacturing is placed on accelerated national security schedules. Silver is designated a strategic material in multiple jurisdictions. And China, which has already imported nearly 800 tons of physical metal in the first 2 months of this year alone, restricts silver exports under the export licensing framework it has been quietly building for exactly this kind of moment. In this scenario, the COMEX paper price becomes a number on a screen that no longer accurately represents the cost of acquiring physical metal. The physical premium, already running several dollars per ounce in Asian markets, expands to $15, $20, $30 or more. The registered inventory at COMEX, currently at 124 million ounces against paper claims of 7.5 times that figure, is simply inadequate to the delivery demand that a genuine supply squeeze generates. In this scenario, the question is not what price silver reaches. The question is what price silver is available at, and those two numbers may be very different things. In all three scenarios, silver goes higher. The variable is not the direction, the variable is the speed and the magnitude. The slow scenario produces significant upside from current levels. The fast scenario produces generational upside. The extreme scenario produces a restructuring of the silver market that will be written about for decades. That is asymmetry. That is the mathematical structure of a trade where the downside is a gradual move back toward recent support, and the upside ranges from significant to historic. There is no scenario on this list, no plausible path through the next 90 days, in which the closure of the Strait of Hormuz and the destruction of 20 million barrels per day of oil supply is bearish for silver. None. Zero. The energy has to come from somewhere, and the somewhere that can be built fast enough is solar. And solar eats silver. Every panel, every cell, every gigawatt. 700,000 ounces. The math does not negotiate. I want to ask you something specific, and I want you to answer it honestly in the comments below, because your answer will tell me something important about how completely mainstream finance has failed to connect these markets. Before tonight, before this video, had you ever seen the Strait of Hormuz oil disruption converted into kilowatt hours, then into gigawatts of replacement solar capacity, then into ounces of silver demand? Had any analyst on any platform you follow, any newsletter you read, any channel you watch performed that barrel to kilowatt hour to gigawatt to ounce conversion and shown you the result? Because I have been looking for that analysis for weeks. I have not found it on any financial channel. The energy analysts discuss oil. The precious metals analysts discuss silver. The geopolitical analysts discuss the strait. And almost no one is drawing the pipe that connects all three. That gap in the analytical coverage is itself information. It tells you that the market has not priced the connection because the market has not yet made the connection. And markets that have not priced a real and large demand shock are markets that will eventually and often suddenly price it. That is not a prediction. That is a description of how price discovery works. Let me give you the complete inventory of the stress in this market so you can carry it with you accurately. Silver is trading at approximately $69.80 per ounce tonight. It touched a peak above $120 earlier this year before a sharp correction that has brought it back to current levels. COMEX registered inventory sits at approximately 124 million ounces, having already declined dramatically from over 500 million combined eligible and registered ounces in October. The paper-to-physical leverage ratio is approximately 7.5 to 1. The annual mining supply is approximately 26,000 metric tons. The world has run a supply deficit for 6 consecutive years, with cumulative undersupply exceeding 800 million ounces. China imported approximately 790 tons of physical silver in January and February alone. Solar manufacturing was already consuming roughly 1/5 of global annual silver supply before the Hormuz crisis. And now the world needs an estimated 19 gigawatts of emergency solar capacity, implying 13.3 million ounces of additional ramp-up demand, created not by a bullish investment thesis, but by the elementary physics of replacing missing oil energy with the only scalable alternative. Wall Street, looking at the price chart and the correction from the highs, will tell you that silver at $69.80 has had its run. They will tell you the bull market is mature, the correction is healthy, and the risk-reward is no longer favorable. And I am sitting here with a physics textbook and a spreadsheet and a very simple question. Which of those Wall Street analysts has done the barrel to kilowatt hour to gigawatt to ounce conversion? Because if they had done it, and if they had arrived at 13.3 million ounces of new demand stacked against 124 million ounces of registered supply, with 7.5 paper claims for every physical ounce and a cumulative deficit of 800 million ounces, the word they would use would not be mature. The word they would use would be extraordinary. The energy had to come from somewhere for 100 years, and it came from oil. And in the span of 27 days, that somewhere broke. The new somewhere is solar. And solar is silver. And silver is sitting in front of you tonight at $69.80 per ounce, a price that can only exist in a world where the arithmetic has not been done, asking one simple question of everyone who looks at it. Did you do the math? We did the math together tonight, barrel by barrel, kilowatt hour by kilowatt hour, gigawatt by gigawatt, ounce by ounce. The math does not lie. The math does not have an agenda. The math simply tells you what is true. And what is true tonight is that 20 million barrels of oil created a 19 gigawatt hole in the global energy system, and the only metal that can fill that hole is element 47, and there is not enough of it at any price the market is currently willing to pay. Tell me in the comments right now what you think the market is missing. Tell me what your own calculation produced when you ran the numbers. Tell me where you are watching from tonight, what time it is, what you understood before this video, and what you understand now that you did not before. Because this channel, the OG John Ag, exists for exactly that conversation. The conversation between people who have done the arithmetic and refuse to pretend that the price of paper contracts is the same thing as the price of physical reality. That conversation starts in the comments. I will be there. Start it now.